Good afternoon and welcome to Real Wealth Network's daily webinar updates. Given the massive changes to the economy that seem to happen on a daily basis, I wanted to bring three of our more popular lenders at Real Wealth, along with Ben, who is our Director of Investor Relations at Real Wealth. And so Chaley Ridge, boy, I've known you since before, I don't know, maybe 2006?
I think 4 or 5, yeah. That long.
Yeah, maybe even before then. And we went through that sort of up and down cycle together and then back up. Um, Aaron Chapman has been working with a lot of our investors at Real Wealth, helping them acquire loans and build a portfolio as well as Graham Parham. So welcome everyone. This is going to be our first, well, I don't know if it's our first, but one of our first online panels. No. We did one with our investor members, and we need to do another one like that. That was a popular event.
It worked.
So welcome. We have a great response to today's webinar. I'm just looking at the numbers. It's probably the most popular we've had so far. So I guess people want to hear what you all have to say. Very
Let's hope
important.
it's worthwhile.
I know it will be.
You can always hope.
So it looks like I have control over this. There we go. This is our lineup for the week. Today, of course, we're talking about the lending environment. Tomorrow, we'll be looking at property management in Cincinnati and what they're seeing there. Last time we talked to Missy, it was right at the beginning of all of this. So it'll be very interesting to see how April has turned out so far there. Thursday, we are looking at wills and trusts. And this is, again, the topic I didn't really want to do because of the topic, but it's something that has to be done. We've got to make sure that we all have trusts in place, because a will, it can cause a lot of family issues if you don't have your trust in place and updated. So that will be Thursday. And then Friday, we'll be looking at Dallas and what is going on there with our team there. Every single metro across the country is experiencing a different part of its cycle and is affected differently. And it's been fascinating. It's just been absolutely fascinating. So if you haven't turned into our past webinars, please do, because you can find out what's happening in Indianapolis that very much surprised me, very positive. Same with Cleveland and Birmingham. So a lot of the strategies that we had implemented over the years, kind of expecting or predicting something like this, it seems to be so far working. So, all right. Disclaimer, make sure that, there's going to be some opinions. I want you're all very experienced. I want your opinions, but I do want our listeners to know these are just opinions. So don't rely on them. We want to share with you, and it's sometimes scary in this litigious world to share an opinion anymore. I get a 1-star review whenever I give any opinion that's different than what maybe a certain listener wants to hear. So we're going to do it. We're going to give opinions today, and remember, don't rely on it. Always ask your own advisors, your CPA, your attorney, if whatever we say is right for you. All right, moving on. So again, we'll just kind of go over, I gave a brief intro. Graham Parham has been a mortgage loan officer for 21 years. It's not your first rodeo, huh?
No, it's not. God, that's a bad picture. Thanks for throwing that up there.
I think that's a great picture.
Go ahead.
Yeah,
It doesn't look much different than what we see on the screen, Graham.
Okay. And thank you, Aaron. I appreciate that. I'll have my turn momentarily.
It still looks like you.
Anything you want to add about your experience? I mean, you're a broker, so you work with different banks, or
Well, actually, Chaley and Aaron and I all work for basically we're a mortgage banker, which we're not necessarily a broker, which means that what we do is we gather all the information just like any other lender will, and we bundle it up. We don't have to ship our documents across town or out of state. We underwrite those in-house, okay? Well, we fund the loan with our own money, and then, of course, we service the loan post-close. So we're really not like a broker, but we're not like a bank because the banks right now, because of their servicing platform, they're getting inundated with all kinds of calls. But that's kind of the makeup of what we do is everything's in-house. Jaylee has her team, Aaron has his team, and we all, work together to try to put these loans together in a really quick fashion and get them out the door. But, as far as a broker, we don't have to sit around and wait for somebody else to do their job. And I was talking to Jaylee just yesterday. We were talking about getting people to do their jobs better. So I know she can chime in at any point in time and say, she cracks the whip and makes sure everybody's in line, right, Jaylee?
I have a pretty far reach, yes, but my team is fantastic. I couldn't do any of this without them.
Very good. Well, thank you for that explanation. I appreciate that. So that does bring us to Jaylee, CEO of Ridge Lending, a nationwide lender for 22 years, and also established real estate investor and has held up to 42 investment properties at any one time. And that is so important because you understand where we're at.
Yeah.
Maintains and serves a database of 65,000 investors. Amazing.
Yeah, thanks. Yeah, I think the unique perspective, well, I hope that, and I don't think I'm alone in this category. I think both Aaron and Graham can probably tout the same. But I think having that background as a real estate investor, that unique perspective, adds a little bit of credibility to who we are as lenders and what we can bring to the table. I think it's pretty different than what you find out there. And I think all three of us here today, in addition to what you do, Kathy, and I think this is why you and I have aligned so well over the years, education is really the platform that all of us speak from. It's so important. I'm always saying that the learning curve in real estate investing just on its own, you guys, on its own merit is extremely intensive. There's so many moving parts. And when you start to layer in the financing, obviously it exponentially increases that learning curve. It's almost like learning a new language for a lot of people, but it's the leverage, right, or the use of other people's money that really gives us that greatest rate of return on investment. So if I were going to say value add about me and probably my fellow panelists, it would probably be that, the education that we're here to provide.
Absolutely. Yeah, which brings us to Aaron, who has been at several of our events as well, educating our members on how to build wealth through leverage. And some of you know that maybe that's how I got my start, was in the mortgage industry back in the early 2000s. But Aaron's been in the industry since 1997, has worked with a broad base of clientele from first-time home buyers, people building their dream home, to investors buying multiple properties for long-term cash flow. Ranked number 14 in over 300,000 loan originators for transactions closed annually, and totally fits the bill of what you would think a mortgage lender looks like.
And like you said earlier, I dressed for the occasion today too, because
Yes.
in reality, I'm supposed to be in New Zealand hunting right now. So I got hosed out of that with this whole COVID thing. So I'm dressing for the occasion I'm supposed to be at.
Oh,
In my camos, dang it. So, but they can see on the picture how I normally dress, which is not much different. And I find that's something that, people I want people to see the unfiltered version of what's coming out here when it comes to whether it be lending, whether it be me as an individual, or the advice we have to give. A lot of that, actually, some of that has changed. Yeah, I've worked with a broad base of people, but I focus on the investor now because I just enjoy working with the investor. It makes sense to me. I understand the nuts and bolts of what they're trying to do, not somebody's emotional thought process of why they need that house on that street, even though it's more than they can afford because it's their right as an American, right? And the only other thing that's an error there is that ranked 14 over 300,000, that's last year. Now I'm down in the 20s. I did more loans than I did in 2018, but in 2019, some other people did more as well. So not quite ranked in the teens anymore of those 300,000 people. But thank you for the intro, Kathy. I appreciate it.
You bet. Now we're going to take questions, but first we got some questions before that were sent in, so I will get to that. And then this is the big one. Forbearance. So this was something Graham had put on his list of things he wanted to talk about, but we're going to start with Graham and then go down the line. There has been a lot of talk, myself included. I may have not been totally right on the forbearance process and what it actually means. So let's talk about that, because here we are being told, hey, maybe your tenants aren't going to be able to pay. And so the response is, oh, well, then maybe we don't have to pay for a little while through this thing called a forbearance. But what are the implications that maybe we didn't see in taking it so lightly?
Well, I think for the most part, the way you described it, it is, it's available for the people that have these mortgages. This is not a forgiveness program by any means. It's a
Hmm.
suspension of payment during a certain period of time. Right now, I think the government has it at 4 months. I know our company, we are right at 3 months, and I think Aaron, you're the same. You're at 3 months. I'm not sure about you, Chaley, if you're at the 3 months, but during the forbearance period, the payments are suspended. Okay, there's the automatic payment withdrawal, that's suspended. They don't make any payments whatsoever. But the thing that I think you've described several times, Kathy, is that this is not a good thing. Okay, because the investors that are in this thing, they got in it for a reason, because it's an investment. When Chaley and Aaron and I, we did a loan for them, we asked them to provide us with a thing called reserves. And this, guess what? This is the time to use those reserves for something just like this. That as a lender, we designed this. But what forbearance does is you can call your lender, and oddly enough, you can go through a very short 4 or 5 questions. You'll have a counselor, if you will, on the other line trying to explain the whole program to you, the ups and downs. And they're even trying to encourage you not to do it. But a lot of people think, I'm in dire straits. And if some people that truly may be in dire straits, well, they need to take advantage of this. So, but the repercussions of it is that you get the suspension for 3 months. Let's say the payment's $1,000 a month. Well, okay, you built up $3,000 here that you've waived for, if you will. But on month 4, that $1,000 also is due in addition to the 3,000. So now you got to pay 4,000. You better be prepared for that. Wow. And if you're not, then you have to go back to the servicer. You have to reevaluate your situation. Worst case scenario, you may have to apply for loan modification. And that's where it gets kind of tricky. The loan modifications that we had, back in 2008 are much different than the ones that we have today. But as far as coming back to haunt the mortgage holder, the investor, if you will, it won't affect your credit during the 3 months. At the 4th month, if you don't pay, then of course it will affect your credit. They will start nicking your payments or nicking your credit that you're late on your mortgage. And if you decide to go and apply for the loan modification, well, those things don't happen overnight. It may take 2 or 3 months to get it all set up, where they're going to keep hitting you every month for a late payment. And then if you do qualify for the modification, that comes back to haunt you down the road. Even if it takes a short period of time and you get out of it, it still goes against your credit. And I believe the last rules were 2 years. Am I correct, Aaron and Chaley? Is that where we stand right now on mods? I haven't done anybody with a modification lately, but I think it was 2 years, right?
Well, I think what I'm hearing, sorry, Aaron, if I can just interject, Graham, the forbearance, the credit score itself will not be impacted, right? Just as you said, there will not be showing any mortgage lates. However, it will be illustrated on the credit as a forbearance that you participated in forbearance. What I'm hearing is a few of the biggest banks, at least to start with, have already written into guidelines as an overlay that those individuals that took advantage of the forbearance, even though your credit score is still intact, are not eligible for conventional financing for that 24-month period at the end of the forbearance. Yes, that's what I'm hearing.
So basically what you're saying, it circles back to that same company. So if somebody at Bank of America does this and they want to go back to Bank of America, then Bank of America says, no, we can't do that.
I'm understanding that it's probably going to be pretty much industry-wide, the forbearance. I don't think it's just going to be 1 or 2. I think a lot of people are going to jump on that philosophy, and the forbearance is going to create a 12 to 24-month suspension of eligibility for conventional loans.
The thing about this whole forbearance right now, it's still a moving target, okay? What's set in place today may change tomorrow. And the sad part about it is the change may extend our 3 or 4 months to even a year. So, I mean, you're starting to build up all these payments for a year, and it gets even worse. Once again, if you can, whatever you can do to avoid that, please don't do the forbearance. But even during the forbearance period, let's say it's 3 months, you had some difficulty, you're going into forbearance because your tenant didn't pay on this particular house. Now the tenant's paying again. Okay, well then I can start paying on my forbearance. And that's true. You can send the money in but it goes into a suspension category until the end of the forbearance. So you are sending it in at the end of the forbearance. They will apply that to whatever balance you have and move forward. So, I mean, they let you do that at least.
It just seems kind of silly. Like, I would think that if you, using your example, $1,000 of rent or your mortgage a month, and you delay it by 90 days, I always just thought it would mean that you're adding 3 months on the end of the other end of the thing, 30 years down the road. But if they
Right.
expect on the beginning of month 4, you have to now suddenly cough up $4,000. I mean, the odds of being able to do that only 90 short days later are pretty slim. I mean, what good is that?
Exactly. What good is it? I think in the modification, Chaley, and help me out with this, but back during I think it's the HAMP program, that the way they described the forbearance back then is they would actually defer the payment. What would they do? Say if you had a $500,000 loan and you can't afford it anymore, and what can you afford? And so they say, okay, we're going to take the balance to here, reamortize the loan. If you can qualify for that payment, then we're going to keep that in place, defer that, say, $200,000 to the back end of the note. That's typically how those loan mods work. So once again, it's not forgiveness, but Chaley, you've been at it this a little longer, so chime in on this one.
I would just offer that it's not going to be a blanket for everybody. I think that the servicers are going to be the ones that are in charge of how this plays out. And as Graham had pointed out, I think there'll be plenty of them that operate exactly in the fashion that he said. You miss 3, 6, 12 months, and then at the end of that term, the amount deferred is due. I think others are going to find that, yes, they can just tack it on to the end of the loan, right? So when you go to sell or refinance, that amount is due. But remember one thing about that before I kind of give you some examples of what else I'm hearing might be viable. Because let's just say, and I've been hearing it could be anywhere forbearance from 3 to 6 to up to 12 months. Let's just say that somebody just decided to not make a payment for 12 months. They skipped a year, okay? So the average life cycle of a mortgage is what, around 10 years on average? So at the end of the 10th year, right, if they go to sell or refinance this, they've only paid 9 years. So when you look at an amortization table, you guys, and I don't think a lot of people are paying attention to this, not only is that 12 months of mortgage deferment due, but the amount that you owe because of the amortization after 10 years, you skipped a year, is quite a bit more than you would expect it to be. So, there's some other casualties, I think, involved with all of this that people aren't realizing. If I might just offer a few other points, and then obviously you guys have plenty to say, I'm sure. The other things I'm hearing might be a possibility are the modification, like you said, Graham, maybe they stretch it over the remaining term of the loan. There's also talk about there being a second lien, right? So they add a second lien for the amount that was deferred onto what you didn't pay. So in second lien position, that becomes due upon sale or refinance. So it's really up to the servicer as far as I know. But one other thing I want to mention, and this is really important, there's a lot of unintended consequence, and I'm going to get into some of that when we talk about market conditions and secondary. But one of the unintended consequences that is not being mentioned, I feel like the government has been almost reckless with the delivery of some of this information. They're making it sound like it's just a free ticket to ride. And the truth of the matter is, you guys, when we don't make our mortgage payment, the servicer is still obligated. I think, Graham, you touched on this a little bit. The servicer is still obligated to make that PITI payment. The taxes and insurance still have to be paid. The note holder still wants their money, and the servicer agreement is still obligated. There's a very wide-reaching spider web and trickle-down effect here that goes on. So while my contention is the forbearance is really supposed to be used for those that in desperate need absolutely can't make their mortgage payment. If it's a choice between just trying to stockpile some cash and you make your mortgage payment, right? That's my 2 cents. Anyway.
Well, no, I mean, the investor has put in 20-25% or more equity into that property. Do you really want to jeopardize that and lose all that equity that you put in there? No. Make the payment. As Chaley says, it'd be ridiculous to not make the payment as an investor.
Well, not just, the jeopardizing the equity a person's put into it. You're jeopardizing your ability to expand your business. An individual is getting into this game to build a business, and that's the mindset we get into at the very first conversation. They're the CEO of their real estate investment business. Their job is to properly operate that business and plan for these things. Now, was anybody planning for this? Hell no. None of us saw this coming, but it's here. And since it's here, I know that they can take advantage of it, as Chaley pointed out, as you pointed out, Graham, that maybe they could use this as a way to get more reserves. You know, this is the last bullet in the gun when the enemy is at the gate. That's what this is for. This is when you just take yourself out, because if you do it just for the fun of it, or just to try and build up some reserves, you're putting yourself in jeopardy, because you're changing the terms of what you agree to. Now, whether they put it on the tail end of the loan with a modification, whether or not you have to pay it on month number 4, it doesn't matter. It's never going to be as easy to pay as it is right now. It's always going to be more difficult. And if you're putting it on the tail end, if somebody tells you on the phone you can do that just by applying for the forbearance, get it in writing, because there's no way that's truly happening. They have to change the terms of that loan. This is truly a modification. And if you modify your loan, what you said is that you cannot financially maintain what you have promised you could. So what you're going to put yourself into is into a timeout. And it's not a penalty. It's you told the world, I can't afford this. So they're going to say, get your shit straight, and then we will set you in line to be able to buy later. So understanding that they're going to set you aside, not put you in a position to have to take on more debt. And then, you know, as Graham keep pointing out, if you're running a business, a real estate investment business, and you weren't preparing for anything like this and setting aside cash flow for reserves, you were being really you weren't being responsible with your business at all. In fact, if you're taking any of that money to get your company Tesla, you're taking any of that cash flow for personal things to go out on trips or whatever, in the corporate world, that's embezzlement. You need to think of your business that way.
And remember, you guys, the bottom line, I think, for most people listening is going to be that the forbearance, almost certainly, even though your credit score is going to be intact, that forbearance will hinder your ability to qualify conventionally in the long term. And just one quick thing, Aaron, you brought this up the other day when we were talking, and this was a great point. The other unintended consequence that this could have, think about it for a second. If 25% of the US goes on this unforbearance or this forbearance delayed payment thing, think about the billions and billions of dollars that's going to create havoc on the mortgage lending side. The converse to that, what will probably happen, the guidelines as a result. Aaron, remember you were talking about this? So in the mortgage industry, they only have values to look at to make decisions for guidelines and things going forward, right? We have 08, 09. I mean, we've got plenty of time that has been spent so that the regulators can come up with how we're going to qualify for these things. If this is something that investment property owners or investment borrowers do, I can guarantee you that the restrictions and the guidelines for us to qualify, forgetting about that forbearance, that 2-year thing, the guidelines themselves and the reserves and credit scores and things like that are also probably going to be enhanced as a result.
And I think we're starting to see that now on some government loans and the jumbo loans. Hasn't hit the Fannie and Freddie side, but if we, like you say, if everybody jumps in and abuses this, we will start seeing some unnecessary overlays, which is making it more difficult to, get lending. We're going to slingshot ourselves back to 2009 again.
So I think our advice is clear, Kathy. I think all 3 of us probably concede that forbearance, while it sounds great, it's probably one of those things that is too good to be true. And we are advising, do not do it unless you absolutely have to.
Unless they're, and again, unless, I'll give one example of one of our members who is in a business that was forced to shut down, and they're having their own challenges. Now, hopefully they were able to apply for the SBA loan that could potentially be a grant that gets forgiven if you keep your employees on and so forth, which again, there's people, investors who are struggling. It seems that the government has given some leeway to the tenant, not necessarily the landlord, who is also a person. So it seemed like it was a fair, okay, you don't have to get evicted, but you also don't have to pay your loan during this time. That was really nobody's fault. On the one hand, I totally see your point. We've been saying since day one, have your reserves in place for emergencies. I have personally said 6 to 12 months, because you just never know. You never know if you're going to have a sick tenant. You never know if anything can happen. No one expected this, or some people did maybe, but I didn't. But again, that's what the reserves are for. So I get your point there. But it does seem unfair. Not really anything we can do about it though, if it's unfair. Okay, so there's a lot of questions, but let's go through this and then maybe some of those questions will get answered.
Right.
Where the market is today. Again, this is, Graham, something you wanted us to talk about. When you say the market, are you talking, what market? Are you talking about the economy?
That was you, Chaley.
Yeah, I think I'm going to speak to that one.
Chaley? Oh, okay. All right, good.
Yeah, so what that means is that I was just kind of going to try my best to articulate kind of where this started, what has transpired that's sort of led us to this place, and there's a rabbit hole, okay? I want to prepare everybody. Some of this goes far and deep and wide. I'm going to abbreviate a little bit and just share a few bullet points that I think will be helpful to understanding in a big picture. And then I think Aaron's going to take it and give us some more futuristic, silver lining, glass half full stuff. We've got a lot of positive things that we think we'll be able to share in closing with all this. So let me just start by creating a timeline. Okay, February 20th. Okay, if you were alive at least in the United States, you heard the headline of the stock market crashing. Okay. A lot of factors were at play here, specifically fears of the coronavirus. That was not the only thing, I feel like, and I won't take us back before that because it will get really convoluted, but that was the straw, right, that broke the camel's back, the proverbial straw that broke the camel's back. February 20th, stock market crashed as a result of fears. The catalyst. There was a flight to quality, meaning that we have all these stock portfolios, people were rebalancing. They were selling off riskier assets, and as a result, they were buying out the mortgage-backed securities, the treasury, the less risky assets. When that happened, the converse effect of that is we saw mortgage bonds increase in price. When that happens, we see long-term interest rates decrease. It happens so quickly that if you remember the headlines, mortgage rate interest rates dove. I mean, they took a nosedive, and it was only a very small period of time. What I don't think many people understand is it was probably 3 or 4, maybe 5 days that we had those interest rates in that really, really low level. So as a result of that, we saw, I think that I remember hearing it was about $1.1 trillion worth of refi applications hit the market. Okay, let me put that into perspective. On an annual basis, on average, we're going to see between $4 and $5 trillion on an annual basis, a combination of refi and purchase transactions in the country. Okay, so within a very small period of time, let's say 30 days, about $1 trillion in mortgage applications for refinances. I probably don't need to paint the picture, but capacity issues were crippling. The mortgage industry just could not keep up. So as a result of that, we saw interest rates artificially inflated. They had to slow the freight train. They had no choice. We could not maintain that capacity. There just was not enough bodies physically to handle it. So they artificially increased the interest rates to slow the freight train. We had to clear out those pipelines. That was very important to kind of keep things going. Well, in the meantime, in all of that, liquidity issues, things just started to go from bad to worse to, oh my God, what's happening? Margin calls. Then we started to see the unemployment claims. In the first week that I started really paying attention to this, I want to give you guys some statistics, and most of you probably heard this already, 281,000 claims in 1 week. The following week, 3.3 million unemployment claims. The next week, 6.6 million people are claiming unemployment. So from then to now, and all of the other pieces that go into this, again, I'm trying to abbreviate. I could really take us pretty far down that rabbit hole, but I'll reserve myself. The risk layers that have mounded up are creating those interest rates are still kind of going to stay inflated. The other thing that happened during all of this, it's probably very important to point out for everybody, the federal government in the meantime came to the rescue, or so they intended, some more unintended consequence, and they infused between, I think it was the 16th of March through the 27th, $251 billion of purchases for mortgage-backed securities. That's what they infused into the secondary market. They had hoped that that was going to reduce interest rates and we can kind of get that moving again. Unfortunately, what it did is it just did the opposite. It kept rates on that higher level. The reason for that is servicing runoff, coupled with all that other risk that I just mentioned. It had the adverse effect. Servicing for mortgage-backed securities is really taken a huge hit right now because the value of mortgage-backed securities, at least for the time being, is at an all-time low. Nobody wants to buy mortgage-backed securities, okay? It just isn't. And I'll give you, this is an analogy that I heard recently that really kind of made sense to me. So pretend that you're looking at 10 white pills, okay? They're all identical in every way, shape, or form. But one of these pills is laced with cyanide, okay? Can you think, but the other 9 are perfectly fine, great, no problem at all. But can you think of anything in the world that would compel any one of you to take any one of those 10 pills and ingest it, knowing that one of them was laced with cyanide? Absolutely not, right? A 10% chance of death? No. So if you think about it that way, that is the statistic that they're kind of putting out there with their algorithms, that default for mortgage-backed securities, given all those other variables, is probably what they're going to see in the big picture. So nobody has an appetite to repurchase these mortgage-backed securities. So all of those things are kind of creating havoc. Now, a lot of this, and we touched on this a little bit, really has more to do with those Govy loans, okay? The agency, the Fannie Mae, Freddie Mac. Anybody that's been around long enough to have remembered 08, 09, you remember how devastating it was for us investors. I mean, I think we got hit the hardest with access to capital and funding mechanisms. But as things started to we started to claw out of that, the guidelines for us to get 30-year fixed mortgages, 25% down, higher credit scores, lots of reserves. So we're already in that lowest risk basis right now, whereas those Govy loans, those are the guys that have the lower credit scores, right? Those are the ones that want 3.5% down. Those are the loans and coupling all of that that are really going to creating much of what's happening. One other thing I wanted to mention, so the other casualties, everything that's kind of come about from then to now, and hopefully that trajectory, it made a little bit of sense. Happy to answer questions, but we have lost several components to what we otherwise would have had for funding for investors over the last couple of weeks. Non-QM products, QM stands for qualified mortgage. This was really everything outside Fannie Freddie that investors could access. Those that have maybe maxed out their 10 conventional would go to non-QM. Maybe you didn't fit into the Fannie Freddie box, you would look at non-QM. Gone, eradicated, zero non-QM industry nationwide. Jumbo loans also very, very dry right now. I don't know of anybody that's funding jumbo loans which are equal to anything over 726,250, right, you guys? Jumbo loan. Those are basically gone. And then we will continue to see the tightening of guideline for the Govy loans. Here's the good news that I will present, and then Aaron, or questions or whatever. I think we are primed for opportunity right now. The ones that can still qualify or don't have more than 10 anyway are in a great position to take advantage of that conventional financing. Is that TMI? Did I just go way too far off left field?
It helped explain why rates went up for a bit, and the government trying to move very quickly on something that they didn't fully understand, and the unintended consequences. So, all right, any other comments on that?
Well, one thing that she was touched on a little bit with the servicing side of it, you know, the cyanide pill thing was a really, really great illustration. But it gets back to, you know, everybody asks me, you know, are you a direct lender, and are you going to sell my mortgage? Well, yes, we're a direct lender, and you know, quite often we do sell it, because when you sell it, there's servicing companies out there that will pay, you know, $1,000 to $1,500 for every $100,000 in loans. They're going to pay up front to have the right to service that loan. As they're receiving the payments, they're taking care of your loan for you. They only get to siphon off a little tiny bit, about $300 per year of that $100,000. It's going to take them 4 years to break even on what they bought from you after they pay their overhead and their taxes and all that. Well, with all the people refinancing so rapidly, because the rates were lower and the Fed artificially trying to push the rates lower. And on top of that, the risk of people going, not being able to pay their mortgage because of jobs and all the things Shaylee pointed out, there's nobody on the back end wanting to buy these loans anymore. That's kind of what that whole thing is with the cyanide pill. Nobody's like, we don't want the loans if we have a potential risk of nobody paying us back. So now what they are coming to the table a little bit saying, okay, well, we'll take them, but you got to pay us for it. So now us on the mortgage side, that's another reason why we're seeing the rates go up, because we're not only having to get the loans done, but now we have to pay somebody to take them and accept your payments. So just know there's going to be some other reasons as well that are pushing this up.
It's called a bid and an ask, just real quickly. Exactly right, Aaron. That's a great point. So if I have $20 million worth of mortgages that I'm going to then take to the secondary to have purchased, right, by the servicer, I'm going to ask for $1, okay? And the servicer is going to come back and say, depending on market conditions, okay, I'm going to give you 95 cents. Well, a couple weeks ago, 3-4 weeks ago, I was saying I want $1 for this bundle of mortgages, and they were coming back and saying, no, I'm going to give you 50 cents. Most recently, they're coming back saying, I'll give you $0, or yeah, you're going to pay me to take these off your warehouse line, so it frees up your capital to then go and fund more loans. So yeah.
So then just, this is my personal question. If you had, what you just said the word for it, but your warehouse loans, and then you were packaging them and selling them off. And now that potentially that buyer is not there, the secondary market. So for the three of you, your warehouse loans then would be maxed. Would that be correct?
Not really, because we still have we still are offloading it, right? So you're still funding from your warehouse, you're still packaging it, so there's still, it's just the negotiations from the buyer is way different than it used to be. It's no longer they come to the table with a 1% of the value. They're coming to the table with, you're going to give me 0.5% of the value. So now we're having to go the opposite direction. Rates go up, costs are adjusted. That is also influencing the market. So when a person tells me, well, why aren't the interest rates in the 3s? Well, I have to explain to them all of that so they understand we're still got amazing rates. You still have better rates there's only a small window of time, like Shaylee illustrated, since cavemen were trading bone tools that people got better rates than today. So the thing of it is that you get upset that you're not getting 3.5% from investment property. You got to check yourself. You know, where we're at today is amazing historically. Yeah, it's going to cost you a little bit more. Yeah, your rate's going to be a little bit higher than you hoped for. But the bottom line is you're still kicking ass and have an opportunity at this investment, this investment vehicle, the 30-year fixed loan that I can go off for days about how amazing it is with inflation and with amortization and all these things that pays hundreds of % return, but we're not going to get into on this one.
You know, Kathy, if you think back, 8 months ago, Shaylee or Aaron, we were in the 5s. We were in the middle to upper 5s. We were selling properties with no problem. Nobody ever balked. I think people are spoiled. Okay, they want their cake and eat it too. Yeah, is my ROI better with a 4.5% rate versus a 5.5%? Sure, but you still have a good, healthy cash flow even at the 5.5%. You know, as far as the deliverability, I don't think we're having any problems with the deliverability. Our warehouse lines love us. They want to give us more money. So, like you say, we're still selling these, even though we weren't selling them to some of the aggregators out there, because they're adding on some additional overlays, if you will, saying, yeah, our flavor for risk has changed. We'll take the loan, but we really need to get this, your 4th grade report card, whatever the case may be. So we're just selling all of our stuff 100% directly to Fannie. Shaylee and Aaron, I'm not sure where you guys are going right now with your offloading, but that's where we're headed.
I can answer just a little bit more specifically to your question, Kathy. So what happens is that there are margins within the rates, right? And when we lock an interest rate, lock is kind of a misleading term. We have promised the individual that this is the rate that they're going to get. However, fluctuations daily within the secondary interest rate market. So if I locked you, for example, at 3%, and by the time I go to sell that loan off my warehouse line, rates are really at 4%, okay? There's a 1% spread there. Guess who has to cover that? I do. I promised you that rate and I'm delivering on that rate, but when rates go up like that, right, I'm the one that's responsible. So it's called a hedge, and this is where it gets crazy complicated. But within that hedge, it usually works out because you've got under normal circumstances. We are not living in normal circumstances.
Right.
So when we go to take a bundle of loans and we sell it and they're not going to pay us for it, right? Some of that hedging is where we will recapture some of the loss that we do or we trade back and forth on a daily basis.
Which is why rates would be going up to hedge against that loss. Okay.
Correct.
So right now investor loans are about what are they at right now?
In the fives. I mean, I think all of us can say high fours, low fives, mid fives. It really depends on the variety of variables that the characteristic of the loan is comprised of. Right, guys? Would you say close?
Yeah.
I think we have a lot of questions on just like people's current situation. And I don't know if you can answer this, we're definitely going to do a webinar specifically on this. Just wondering if any of you know, I know if you have a small business, you could apply for that PPP loan and that can help cover your payroll. Not everybody, and certainly real estate investors don't have that, but there is also the grant for $10,000. Does anybody know if that is something an investor with an LLC can apply for to get that $10,000 grant?
Yes, my accountant hit me up with that yesterday. Fortunately for me, a lot of my properties are individual LLCs. And the way he described it to me, and I hate to say this, but yeah, it is a grant. It's free money, and it is $10,000 per. So that is available to investors that have, retitled their properties into LLCs. So
and what is that one called? Is that the EI?
EILD, I believe it's called.
EIQL, maybe?
EILD, I'll send it to you.
Well, it's that one. Okay, so that, again, we will do a full webinar on it, but who would they speak to about applying for that? Anybody
I'm
know?
not sure because my accountant's doing it for me. And I said,
Yep.
well, how much you going to charge me? He goes, I don't know, $1,000, but you'll get 50 back. I'm going, sold, So
Yeah, so
I
you
can
can talk
certainly
to
ask
your
him.
accountant. All right, and
There's also the SBA, Small Business Administration, has a link
go
for
straight
it.
there. Yeah.
Yeah. And
I think my husband applied with us, and I think he did just go through the SBA.
right. It's
So
pretty straightforward, but
I mean, likewise, right? I've applied. I've got a pretty big payroll, right? I want to make sure that in the event I get that covered. So here's been my experience, y'all. SBA is pretty overloaded for obvious reasons. What they have been doing as of late, and I believe maybe as of Friday, they're pushing you to your institution, your banking institutional.
Right.
B of A, Wells Fargo, Chase, whoever you guys bank with, chances are that's who you're going to be dealing with. And
For the
there's
PPP loan, for the one that covers your payroll, right?
I thought it was both. I could be wrong.
I'm pretty sure that because we did apply for that as well. It's the PPP, and you have to go through your bank. We have B of A. B of A was set up. We were one of the early ones, but then I heard other banks like JP Morgan didn't have it set up, and people are. So there's concern that money might run out if you haven't already applied, but definitely look into it. Talk to your banker. You have to talk to your banker that you have your business account with, and that ideally, from what I'm understanding, you also have to have some kind of loan with. I don't know. They've been making it more and more complicated, but you do need to talk to your banker about that, is my understanding.
it is the EIDL. EIDL.
That's it.
The EIDL, that's the one where I think you can go to the SBA site, right, to apply for that grant.
Directly through the SBA.
And get that $10,000 grant. So that would be something you want to get on right away, because that money will run out. But it was specifically set up for small business. And to Aaron's point, as a landlord, you have a business, you have an LLC. Hopefully, if you don't, there still might be an option for you. I think there was potentially some option for the sole proprietor. But if you have the LLC, that's better.
A couple people have written in the PPP, the payroll protection goes through your bank, like you were talking about, Kathy, and the EIDL goes through the Small Business Administration.
Thank
SBA.
you. So that is one way to help you with if you're able to get the funds. And again, I've seen it it changes every day, and we're going to have an expert come on and talk about that. But for landlords specifically, that could be one way to help you.
And Anderson did a webinar last Saturday. I was on it for a little while, and Toby was mentioning, and somebody writes in here, Rory says, I watched the same, so that only one EIDL is allowed per person, not per LLC. So Clint actually directly addresses, if you have 20 properties or 30 properties and 30 different LLCs, you're not going to be able to apply 30 different times.
You get 10 grand per
right.
person. Even so, that I assume they would, if it was a single member entity, they'd find you that way.
Yeah, that'd be a little too easy if you could.
Yeah, yeah. So Graham, good luck on that. You might be paying $1,000
I'll still
for
take the
10.
10
It's still
grand,
good.
right? Okay.
It changes every day, and I think it's because there's not enough money to go around, so they keep kind of making it a little bit harder. It makes sense. Somebody wanted to know the pros and cons of refinancing at this time, and based on what you just said, it may or may not be a good time because rates may be higher based on what you were saying, the hedge, so forth. So why would it make sense for someone to refinance right now, or would it not?
Depends on the circumstances. Aaron, why don't you take this one?
I've always just stated that when it comes to refinancing, if you're able to take capital and expand your business utilizing your assets, that's when I've always gotten behind refinancing. Refinancing for interest rate, I'm just not one that gets in that. I'm not, and that's really one of the other problems that we've run into. One of the things that have pushed us where we are, people scrambling to refi for a rate. You know, a rate doesn't save you that much. It really does in the grand scheme. It looks great on the monthly, but you look on the overall, it doesn't. So if it's strictly for rate, and it's not a significant difference, then I will always kind of stand there no matter what the market is and say it's just not worth it. Cash out to expand your business is definitely worth looking at. You want to talk to your preferred person you work with and figure that out.
And you're able to still do the cash outs right now?
Oh yeah.
Yeah.
Yeah, right now it's still business as usual. There's a couple little nuances, but for the most part, we're still cranking along.
Yeah, I
And,
mean, on these little tiny loans, they're, for the kind of, at least the properties that we promote, they're between $100,000 and $200,000 properties, so the loans are tiny, and you're right, the interest rate doesn't change it all that much,
Right.
but a cash out could get you through, just having cash on hand right now is a good idea.
Well, there's also closing costs involved, and I've been doing these refinances forever. And on these smaller loans, I usually try to say if you can save, $100 to $150, regardless of whatever the rate differential is from whatever 30-year to a 30-year, then on paper, from the cost standpoint, it actually would make sense if they want to improve their cash flow. But if they can, Daily says, can I get my rate down? Yeah, but you're only saving $30 or $40 or $50. Doesn't make sense. And I convince more people not to do it than the people that want to do it.
An easy way to work the math, you guys, and this is my own personal philosophy. If you divide the monthly savings by the closing costs that are wrapped up in the loan, this isn't actual money you have to come with, but if you take whatever the closing costs, let's say $5,000, and you're saving $50 a month, divide those two, it'll give you the number of months it takes you to recapture. Okay, so a couple quick things about that. If you know you're going to have the house that long and longer, yeah, it probably makes sense. I'm usually within 5 years or less. If you can recapture within 5 years or less, and you're going to keep the property that long, it probably makes sense.
Right.
The other thing too, I guess maybe depending on who your CPA is, and I don't know if we want to get into that, some of those costs are tax deductible. So, and Aaron actually has a great piece on the interest that you're paying as a result. A lot of people miss that tax piece that goes into it too. So I think it's a conversation, and it's really relative to the circumstances. So cash out, yes, borrowed funds are non-taxable, and if you can deploy that and get more, I agree with everything they said. Otherwise, depending on your circumstances, even without cash out, it may make sense too. Depends on the numbers. The math won't lie.
Okay. So somebody said, I talked to a broker and he thought that he heard something different on the forbearance. So I think really it just does come down to call. Every loan is different. Every servicer is different. You need to call. And I like what somebody said earlier, whatever you think you know about it, make sure it's in writing and signed and clear, and know that things are changing on a day-to-day basis. So, but I mean, would that be right? Like, call your lender and find out what their specific situation is and their terms are.
Absolutely.
Call every lender you have a loan with. If you've got 10 loans and they're being serviced by 4 different people, call them all. Don't take one's word for it.
Correct.
Yeah. And it would be different, I'm assuming, if it's your primary versus your investment property. So maybe
significantly.
Okay. Many states and cities have paused evictions. Indeed, they have, most have. We are doing daily webinars with property managers to find out how that's affecting. We've been really surprised and happily surprised with the property management teams that we refer members at Real Wealth to, that so far April's looking good. We've only talked to 4 or 5 of these property teams. Tomorrow is going to be Cincinnati, but for the most part, April has gone pretty normal because a lot of the areas that we, that we targeted, they were not just the leisure job, the travel, the restaurant, and so forth. For example, in Cleveland, Kelly was specifically looking at areas near the hospital, near the Cleveland Clinic, and those people are obviously still very much working. And the same with Indianapolis, turns out to be quite a big biotech, yes,
yeah.
area, and FedEx hub, and they're actually having more applications than they've ever seen with people wanting a place to rent that are highly qualified. So just depends on the area and where you bought and what you bought and so forth to see who's paying. So far, out of the thousands of people that own property within our network, we've actually received pretty good feedback for April. So that is good. And then May, many of the tenants will be receiving their stimulus check, which for many of the markets we're in, we're talking about mortgage payments that are on an $80,000 loan, $100,000 loan. They're what, $400 or $500? So many of these tenants, the rent is maybe $900 to $1,200. They're getting a $1,200 stimulus check per person, plus children. So may work out well for most people too. It's just if you're in the high price markets, and I've been seeing this a lot. Let's say you own a rental property in California, that $1,200 isn't going to help your tenant as much as it might in other markets that are more affordable. So it just, again, depends on what you bought and where you own, the state you're in, and so forth. The government says you can't evict until July 26th.
Yeah.
Is that true?
Does it specify
anybody?
no matter the circumstances?
Yeah, I don't think so. I think it's if you have a government loan, right? So that's, again, where we've got to get really clear on what that means. If you own the property outright, does it apply to you? I'm not sure. We need to get that clarified.
Yeah, we need to figure out what that really means, because it may even be just anybody, period. If you're renting it out, you can't evict them. It may be whether you have a loan, whether you don't have a loan. We got to really dig into this and understand this, because, again, we don't want to be the ones perpetuating the misinformation, right? So it'd be good to have a good, solid understanding of what they mean when you say you can't evict. And if they're listening to anybody from the state of California, I'm sure they're saying you can't evict, period, no matter what it is, whether you have a loan, whether you don't have a loan.
That was the recent headline I saw in California, and California is its own country in many ways.
They're the nation's leader in giving away our money.
Well, I'm going to give that to Washington, D.C. this week, but but with California, it's definitely tenant friendly. Always has been. It's why we have not promoted California as a great place to own rental property. The last headline I saw in LA was the landlord saying, look, you've got to prove to me that you're facing hardship if you want to not pay your rent. You've got to show that you've lost your job or there's some kind of effect on your income. And this headline said, no, that's not what the law says. You don't have to prove it. So that's, again, California, that's not what we're seeing so much in the landlord friendly states. Yes, a lot of people saying evictions are closed. Indeed, many places evictions are closed at least till the end of the month or next month. It just depends on the state.
I've got Bob who writes in this question, just taking it away from COVID-19 for just 1 minute and this hardship. But if one is retired on a fixed income, has rental properties, some financed, some owned, how do you present your financial situation in a positive light to refinance, therefore to create more leverage? Most lenders seem to go nuts over anyone without a real job. Is there anything that they can do?
They're usually talking to the wrong damn lenders. I mean, you got 3 of them right here that they should be chatting with, because I hear that all the time. People call us like, I don't have a W-2. You don't need one. I mean, you either make money or you don't. Can we prove 2 years worth of consistent income and a likeliness of continuance for your future? Yes. If you're a lazy ass person at a big bank or at the credit union, then they're not going to work with you because they don't get paid to do anything but sit there. So of course they're not going to dig into the income. I get a little animated on this question because a lot of people, I believe, are unserved. This gentleman right now has had to deal with people that don't want to take the time to look and see that he truly has the income, the assets, and the capability. And we work with them a lot. Chaley works with a ton, Graham works with a ton. These are the people we actually like working with more because it's easier to prove their income. In reality, it's interesting that it is.
Yeah.
And I'm going to add to that, Ben. A lot of people assume you got to make so much money to qualify. It's really not as much about the income itself, the dollar amount, monthly dollar amount, as it is the income in relation to the monthly liabilities that we find on their credit report. So legitimately, if you make $1,000 a month and you only have $250 a month of liability, you're going to qualify.
Yeah.
So remember that detail.
Yeah.
Yeah, and somebody asking a similar question, they've been laid off because, the quarantines don't allow them to work, but they haven't really lost their job, but can they still qualify?
No. Chances are no,
Fortunately not.
unless they've got enough rental income, for example, on the Schedule E, that we can extract enough gain or income to prove that they qualify. Otherwise, without a job, you need a full-time gainful employment if you don't have other sources of verifiable income for the last 2 years.
Even if it's COVID related, just temporary? Okay.
Yeah.
That's a good point. Kathy, maybe we should segue into what some of the changes related to COVID have created for those individuals that can qualify. Aaron, do you want to talk about, last minute, they're canceling signings at the last minute or funding at the last minute because of X, Y, and Z they need to be aware of?
Well, and it really just boils down to is we have to prove that we're not putting this person in a position where they're taking on excess liability without the ability to repay. It's all the way back to the whole Dodd-Frank thing, everything. We've got to be responsible with who we are putting. We're going to call it debt for a minute. I hate calling it debt. I always looked at the loan as the greatest asset associated with your business, but in reality, we have to treat it as debt for just a moment when we're talking about the qualifying. Things have enhanced a little bit. We are going to, take a little bit closer look at the income scenario. Be sure that person is still receiving that income. If their income has stopped at all for any reason, we have to wait till it starts back up again. Because again, we have to have that reasonableness of continuance. Even though today it's a COVID related situation, it's a delayed income. They're saying, hey, you're laid off. We're going to bring you back when we get back up on board. But when is that? We don't know. And so because it's unknown, it's irresponsible for us to say, oh, yeah, we'll go ahead and fund that loan. What if that business completely shuts down as a result? And I hate to even be the doom and gloom thought process on this, but I'm not going to tell you what you want to hear. I'm going to tell you what you need to hear. Is that we have to be protective of all the investors, and we're not going to set you up in a position that's going to hurt you. So We're going to be taking a little bit of a different approach to a lot of things. We're going backwards with our underwriting guidelines just a little bit. The paperwork that we gather, it's not going to last as long, right? So when we put paperwork into a file, we used to be able to put it in the file and then go into final underwriting and closing weeks later. It could be a month and a half later. Now that's not the case. It's going to be something we have to be a little bit more updated on the paperwork. They're cutting that time frame by about 30 days. When it comes to a lot of the loans that used to be available, they're gone. Chaley referenced the fact that the non-QM stuff is gone. The jumbo stuff is fading. A lot of your grant programs, your first-time homebuyer stuff, that's gone too. There's just not a lot of appetite for things out there that are not going to be very, very easy to see that they're going to pay back. So that's some of the things we did notice. Go ahead.
I was going to say I've read just really sad stories about people literally at the closing table and the loan was no longer there. It was pulled, which I would imagine would have quite an impact on the higher end in the future. Higher end
That's
real
mainly
estate.
the non-QM stuff that would do that. I'm one of them. I got 2 of them pulled right before closing. But one of the things I could say is encourage your borrowers when you're talking to Chaley or Aaron or your loan officer, whoever it may be extremely forthright about everything. Don't lie about your employment. Don't think, I'm going to get furloughed here in a couple of weeks, but I'm going to fund the loan here in a week. We're going to find this information out. We have mechanisms in place to find this out. We're not stupid, and we are being a little bit more cautious of what you actually do as a job. Are you a 1099? Do you work for are you W-2? Can we see some additional 1099s, or we're going to check your website if your business is still going? The common sense things. I think we're going to start seeing more of that at the tail end because we do call the employer the day of funding. Are you still there?
Last minute BOE, verification of employment, is happening
Right.
at the signing table. That's how
Yeah.
they're really.
Yeah,
Be
be very forthright with
And
Yeah.
your broker.
and I
With
had to
your-
be that guy calling up and say, guess what? We're not funding your loan because you don't have a job anymore, and he didn't even know it.
Yeah.
So I've
and
had
then
to
you
be
lose
that
your
person
deposit.
before. So
Wow.
yeah, those of us in this industry, Chaley, myself, and Graham, we've had to tell some people some stuff that we don't have. We barely have a pumping heart anymore. The way that we've had to give people news. You consider some of the things, but yeah, I can't reiterate that anymore. Just be very, very open what's going on. The changes are going to continue to evolve. They're going to adapt, but at the same time, also take care of your business. Treat your business accordingly, because how we come out as real estate investors from this will influence how we're able to finance real estate investors in the future. There's going to be a lot of consequences to how we go about this. And if we go about it cavalier, or we go about it in a way that's not honest, it's going to affect your guidelines tomorrow and your ability to get financing in the future. And just know that there's a huge opportunity here. I'm sure we're talking to a lot of people from their home. They're in their house, their kids are in the other room working on their homework or working on their schoolwork, whatever. And there's other people out there that are not on this call, they're sitting in an apartment right now. And that apartment is not comfortable. Their children are all over the place. They can't put them outside because the common areas cannot be, they may have some rules in the apartment complex. So imagine those people cannot wait to rent a single family home. They cannot wait to be out of that to buy to rent something larger with a yard. Real estate investors who are picking these up are going to have a huge flood of potential tenants.
We're
in the
already
future.
seeing it. I mean, we're doing these daily webinars with property managers, and like I said, they've seen more applications than ever for
And
the
the other
single family home, probably in the affordable range. And it depends on the property. It depends on where. It depends on a lot of things. But the ones that we work with, they're seeing an increase in demand for sure.
The other thing too for buying, I mean, we've got the renters and that pool is opening up, but remember too, the iBuyers are not in the market. The big hedge funds, the Blackstones, they're not buying property. Your owner occupied, they're not buying property. So as investors, where sometimes we get bid out because there's so much activity, I think there's another opportunity for us to take advantage of acquiring these properties where our pool is bigger for renters for reasons Aaron just said. And then also the owner occupied that they would have otherwise been buying their home, those guys are now in the market to have to keep renting too. So lots and lots and lots of opportunity. Rates are still among the lowest in history. Just saying.
Mm-hmm. Yeah, we have a few owner occupied questions. I don't know if you can answer that, but let's say someone's about to buy a home.
We still do them.
Contract. April, May, one spouse loses their job, things change. Is there any flexibility with owner occupied?
What's the question?
It's all.
It's either qualify or you don't qualify. It's the same thing. You either qualify or you don't. I mean,
it's the same. Yeah. So if
in fact, that actually, in that situation, we're at greater risk as a lender. Sorry, I'm talking over you, Kathy. I apologize.
That's okay.
But, we're at greater risk as a lender to put somebody into a home that's their primary residence, and pushing those envelopes as far as ability to repay is concerned, because that is truly 100% their expense. It's not like being able to take an investment property and use a renter to offset the expense. Just know that we can't do that. So since it's 100% on top of them, and if we're putting them up in a position that's really putting them at risk, that doesn't fare well. And karma is going to come back around and cause all kinds of grief. But the government has things in place to come after us if we do something along those lines. And we're just not. I'm not interested in a bunch of black SUVs taking all my parking spaces.
Someone said read the CARES Act. We have, but the way it's playing out is a little different than the way it's described, and that's why we really do need to get an update webinar on it, because it again isn't quite playing out maybe the way some of us thought it would. All right, so VA had assumable loans for investors buying a VA property through foreclosure. Some investors, such as me, do have some VA loans. Mine are from the 90s. Is that something that would still be a possibility to buy? I think it is, to buy someone else's VA loan. Is that?
To do an assumption on a VA loan?
Yeah.
Chaley, you look like you were waving your hand for that sucker.
No, I don't do that.
No, it all
Okay.
depends upon the loan. You got to go. In fact, I had somebody ask me about assumable today. I'm like, wow, they haven't done those since the 90s. And so here we've got somebody who's, you could be sitting on a gold
Did
mine.
it-
I mean, they're
There was some
reality.
right after the '08 bust. I did hear some cases where they made those available, but you're right. I think the cutoff was like 89 for the fully assumables, heartbeat and signature kind of sign things. But I think there was just on VA, not FHA, that there was some assumable programs out there, but it's case by case and whoever the servicer was. But that's, once again, that was back '08, '09. I don't think it is today.
Okay. Somebody is saying, and I think this is important, and it's again different for everybody, that it sounds like maybe they're thinking about doing a forbearance, but they also were thinking about buying a property in 5 months, and their lender said no problem. I think that's going to be a big problem.
It's
You're not going to qualify for a new loan if you're doing a forbearance now, right? That just
Correct.
seems odd.
almost.
Okay, that would be my belief. I thought it was different. I thought that there would be a little more flexibility for investors, but yeah.
It's going to be.
Well, let's break that down just a second. Let's break it down just a second. You're doing is you're going at you're applying and indicating to people, listen, I'm having a hard time making these payments.
Right.
We're taking out the fact that a person's trying to just put themselves in a great business position. Let's take that out because that's not what they're thinking. We as investors think differently than the banking entities, the government, everybody who's putting this out. They're saying forbearance is there for people with true hardship. And if you're stating I have true hardship, but then I'm going to go buy another home, well, now you're talking out both sides of your mouth. So there's no way you're going to be able to get that other home done when you're saying one thing.
Yeah, I would be very cautious if you're wanting that if the home you want to buy is more, I would be cautious there.
Way more important than the forbearance.
Yeah. Okay, the government should have let the landlord-tenant relationship work it out through the market. Wouldn't free market economy be amazing? Yes, we don't have that today. Don't mistake today's economy for free market in any way. It's not.
The three of us will convene and figure out eviction. Who can, who can't, nobody, somebody. We'll get some answers to that and send it to you guys so you can give it to your
Thank
listeners.
you, because we understand it from a statewide perspective, what the states are saying, what cities are saying. What was confusing was this government mandate that you couldn't foreclose for 120 days or evict if you had a government loan. But what is that loan? So we need explanation. Thank you.
And we're getting different directives from everybody we talk to. So it's still, there's a lot of interpretation that needs to be ironed out.
Okay.
Yeah, we might want to do another one of these because these questions are there's a lot of them.
There's
no
so
way
many. We probably should have commercial lenders on. Do you guys lend for apartments, commercial loans at all?
I do. That's something actually I do broker. So we have our own funds to lend on the residential side. We broker our commercial, and as far as I can tell, commercial's taken just as big a hit as maybe jumbo. It's not totally gone, but I had a client that was at the closing table in a commercial 100-unit apartment complex. They had 12 months of MI and they jacked his rate an extra point and like 10% more down to close. So it's having its own set of issues.
Big issues. I mean, bigger, it seems, for commercial. I mean, literally, if you were in contract right now to buy an apartment and had a commercial loan approved, you might not close. So that's, woo! That's a world.
Here's the question. Are there still lending options for investors with 10 loans already? I mean, that would be the non-QM, non-qualifying mortgage, which has pretty much been shut down. So
I can speak on that.
Okay.
The answer is yes and no. The bigger lending institutions that, as you say, all the doors are shut. I mean, they pulled the rug out from underneath us. One of the things that I'm in the middle of right now is trying to, backfill what I lost 2 weeks ago. And you can actually go to the little smaller banks in those areas. And I've actually found one in Indy that's willing to do a pretty reasonable type of loan. I found another one in Memphis, Tennessee that's willing to do, we're not quite like the 30-year fixed rate with a 4.5%, rate on it. It'll probably be like a 5-year arm. The ammo may be a little shorter, but there is some money out there to be had. But it's like turning over a bunch of rocks to find it. But these little small local banks, if you're outside the 10 box, that's where I would start. And ask your provider because they know who they are.
We just got an interesting comment, and I'm not surprised. I haven't looked into this at all, but Someone's saying I have 10 loans. I was in escrow with a non-QM lender. Did you just ask this, Ben? You might have.
No, it's similar, but no, that's a good one. Ask it.
Okay, they agreed to continue with the loan, but I had to put an additional 10% down. However, they're requiring the rent loss coverage that was through NREIG was one of the ones providing that. Now, Ben, we talked about this because so many people wanted that, and I thought,
Mhm.
wow, I don't know how they're going to make that work
Right.
right now. And sure enough, it looks like NREIG has pulled it. So is there any other rent insurance company out there?
Yeah, I've never had a lender require that I carry loss of rent coverage.
Yeah.
It's always just kind of been a rider that sometimes they slap on. And one time I was pleasantly surprised when I had a tree fall on my roof and hey, I've got loss of rent coverage. It actually came in handy, but I didn't know anybody was requiring it. And this questioner is saying, hey, they're not going to, the lender will not fund the loan if I don't have loss of rent coverage, and NREIG is not offering it at this time.
So I want to just kind of interject.
Yeah.
And you guys correct me if I'm wrong. Everything that I've done on a conventional side absolutely requires 6 months rent loss on the residential binder, insurance binder. And that's the first place I looked. When all of this started to heat up, I called the people that we work with most often, and I said, hey, under what circumstances does a natural disaster like this qualify? Can they make a claim for rent loss for something like this? And so far, every one of us, or every one of them has told me, no, the rent loss that we pay for our investment property won't cover something like this, but it is required. It's required on any loan I've ever done.
Oh, from your normal insurance company.
Correct, the homeowner's insurance policy.
Okay, so it's homeowner, maybe that's what they're asking. I'm not sure, but yeah, but it still doesn't cover it.
Doesn't
Right.
cover
For
this.
this. Of course.
Yeah.
Okay. So there's somebody asking about non-performing notes. We don't really, I don't think we can talk about it on this one, on this webinar, maybe on a future webinar. 30-year loans are great, but in your experience, do you have a recommendation on how much loans to value on your personal net worth is on how much loan to value on your personal net worth is acceptable? I'm not sure I don't think I understand.
Loan to value depends on the property type, the occupancy, and other variables, but generally speaking, 80% for an investor, 75%.
On the property.
Pretty
right?
commonplace as far as our LTV. So if you're putting on your net worth, when is it acceptable to use a 30-year fixed when you're trying to get, they're talking about influencing net worth, having a loan. So they're looking at it as liability is what which in a way it is, but I'm looking at it as asset because somebody's telling me I get to pay them for let's say I'm buying a $100,000 property, 20% down. I'm financing 80 grand, right? I got somebody else paying off the 80. As long as I'm keeping it rented, I bought the right property, got the right property management, working with the right team like Kathy and team here. And then they're paying me and I'm giving over to the mortgage lender for 30 years the exact same dollar amount, even though inflation is making my dollar decline. So the dollar's losing value every year. I'm paying it slower over 30 years. I'm paying with a diminishing asset. By the time I'm done with it, I'm never even paying back the damn principal. I've got the numbers for that. I've got the algorithms that break this down. It came from the professor of accounting at Kennesaw State University. I have the tool. That is the greatest asset. You borrow 80 grand, you give them back 62 over 30 years when you factor in real dollar value. So that 80,000 is a massive asset when you're considering that loan in the right way.
Aaron, I think you really brought up probably the most important issue here is the way that our government is handling this crisis. There was a couple of ways to handle it, and one would be just to let it go and people default and we head into a depression and things are bad. They're choosing a different route, which is throwing money at it, unlimited money created out of nowhere, which essentially devalues the dollar. And when you devalue the dollar, that tends to, the whole point is to lift up the value of assets, right? To devalue the debt and increase the value of assets. That's what they're trying to reinflate. So to be able to lock in a loan, I mean, usually in that environment, having debt is a good thing because that's what they're trying to make less. It's like for debt to just be worth less. So that is one of the values of being able to own an asset that the government is trying to inflate while trying to deflate the dollar. That's I mean, is that what you're
Yeah,
saying?
the instrument that you're going to pay it back with. Yes, it's huge when you're considering the inflation piece that's here. Now, I get that everybody's thinking when I get a mortgage, that's a 30-year fixed debt. That's the eighth wonder of the world. Compound interest going to kick my ass for 30 years. But when you put it in an inflationary environment, it's one thing that Einstein did not calculate into a 30-year fixed mortgage in an inflationary environment being paid back with a depreciating asset that's rapidly depreciating even faster, especially if you consider the appreciation of toilet paper right now. You stagger that all in there, they're paying less and less and less back over time. Because every time you make today that dollar is worth 80,000, right? Well, every time you make a payment, that dollar you're giving it back worth is less, a certain percentage less. Even though the government says inflation's kept at 2%, that's only on the PCE and the CPI, small things being measured. You look at everything, it's 10 plus. And it's higher now because of what they just did. So you're not paying back that principal at all. You're paying back a lot less, significantly less.
So I think this question, I don't know, to Chaley, will your underwriter still fund a loan if you're in escrow closing on new construction and you put a few of your properties in the forbearance program due to Corona? However, it's not showing up on the credit report.
If I know about it personally, no, I will not fund your loan. I don't know how we would find that out.
That's the answer. Okay.
We would find out doing a credit supplement. If we did a credit, because we do a credit supplement on every single one of the stuff. So
if they're
and what that is we do a soft pull at the end, and we'll see it on the soft pull. Is what you're saying, Aaron?
Not if it's not reported yet.
If it's not reported yet. Okay.
Yeah, if it's not reporting on a credit supplement, it's not showing up. And when we're updating the mortgages, making sure they're current, if they're not saying anything about that, then there's no way to know. But if we know, we're obligated.
Yeah. Can I add one thing to that? And this, I don't think we've talked about this yet. So first payment default. So let's say that you qualify for a mortgage with us and one of us funds your loan and you decide to take advantage of the forbearance before you even make your first payment. That's called first payment default or early payment default. The consequences that come back to me, just so that you know about that, is thousands and thousands, if not tens of thousands of dollars. One, I can't sell that loan anymore. It's going to sit on my warehouse line for say 100,000. Let's say that's the loan amount. Scratch and dent. I've got MSR I've got to repay. There's a lot that goes into that. So don't do that to me, please. I haven't had one yet, but I know what the expense and the cost would be. So if you're going to get a mortgage right now, you need to be assured that you're going to be able to make those payments.
All right. Let's see.
A lot of these they're kind of repeats.
Yeah, there's one that says, is there a model for the best percent for the down payment and when to start paying down the principal while maximizing writing off mortgage interest? So is there a percent down that you recommend? I mean, personally, I kind of what to Aaron said earlier, the interest rate is so, it doesn't affect these little tiny loans very much. I personally would put less down to have more cash available as reserves and to be able to potentially buy more properties. I'm always about put less down with these interest rates. Why would you put more down? In my opinion.
Well, I mean, take a look at if you're buying multiple properties, you're putting an additional 5% down just for rate. By the time you get to property number 4, you've just wasted the down payment for property number 5. And the 5th property will always outperform the other 4 with a slightly lower rate every single time.
Yeah.
And I just jumped in front of Chaley because she did that to me like 10 years ago and I owed it to you.
I'm sorry. I was just going to say that you guys, the math will not lie. And anybody that has a rate of return calculator for real estate, you look at it at 25% down and at 20% down, even though the rate is lower over here and the loan amount's lower over here, it's exponentially greater with the higher leverage. Always take the higher leverage. Now, there's exceptions to every rule, but I'm going to say 9.9 times out of 10, the higher leverage is going to be to your advantage.
Because I would rather have that money as my reserves, you know? I was very upset with a family member who put so much money down because they just wanted that security. And I'm like, that's not security. That's money you can't access. I'd rather you put less down and have the money somewhere you can access if you need it. That's, again, my opinion.
I think we all agree with that.
Yep.
Okay. Let's see. See any more questions there?
Well, No,
We got a lot of these, yeah.
couple of them. A lot of them are kind of repeat, so it's and we've kind of moved on. So I think we should do part 2, frankly.
Yeah,
I
we'll do
mean,
part 2. We've done an hour and a half. My goodness, and everybody, a lot of people are still here. Thank
Yeah.
you. Thank you. This was
Mhm.
obviously a very, very valuable webinar for a lot of people because they're still here. Thank you. We have so many more questions. We'll have to
I
do
know.
part 2 for sure.
Kathy, I just want to jump in really quickly. If anybody wants to get the contact information for Chaley or Aaron or Graham, it's all on our website. Just log in, and over on the left under lenders, they all pop up. You can just select any of them, and there's their smiling little thumbnail picture and contact information. It's all right there.
Smiling on his.
Oh yeah, Aaron's not
I
smiling.
don't know that I am.
He looks very
So
stern.
don't go for smiling. Don't look for the smiling pictures. Go alphabetical order. It's much easier.
All right. Thank
There's
you all
your
so
smile.
much. Have a
Thank you for having us, Kathy. Ben, you guys
Thank you, Kathy. Thank you, Ben.
You're welcome.
take care.
Thanks,
Bye-bye.
everybody. Bye-bye. We'll do it again soon.
awesome.